Hello, this is Mark Schweiss from Modern Dollar Planning. We hope all is well with you. It's been almost 3 weeks now since the one big beautiful tax bill was signed into law on July 4th by the president. And we wanted to be proactive and reach out to everyone now that we've gotten through the 900 pages that it entails, because we thought it would be useful for everybody to understand how much or how little this may impact your taxes, your individual taxes going forward. So I apologize for the length of this. There's a lot to go through, but after viewing this video, if you'd like to reach out to Jacob and I and ask us to run an individual 2025 tax projection for you to actually nail down what tax savings you may or may not have, we're more than happy to do so. So this new tax law that they signed into law, we know a couple things about it in general, and that is the fact that it made tax preparation, individual tax prep, actually more complex. In 2017, Trump passed his first tax bill, and as part of that, they were trying to make tax prep more simple. And actually, this go around, they've actually made it more complex. So hopefully you don't do your own tax return prep. We also know that the government debt levels most likely are going to increase, not decrease, as part of this. And something that people may not understand, but a lot of the individual tax law changes that they made in this one big beautiful bill are set to expire in either 2028 or 2029. Now, we generally deal with individuals, high net worth, high income individuals. Some are business owners, but they tend to be in the service industry. So what we're not going to touch on, because there's a lot of additional items in this tax bill that do not impact our clientele. Those are things such as Medicaid changes, the taxation on your tips and overtime. We just don't have clients that rely on that type of income. One thing to note is that if you sell things on Facebook Marketplace or Venmo people, that they're going to go back to the old rules with the 1099-K reporting, which you have to have more than $20,000 worth of income and over 200 transactions before this 1099 report is required, whereas in the past few years it's only been $600. In 2017, that tax law change basically eliminated most of our miscellaneous itemized deductions, and this go around they made those permanently disallowed. Section 179 depreciation we're not going to touch on. Student loans, we have a fair number of clients that do have student loans, and this was a big change, or will be a big change, so we're going to reach out to them individually. Alternative minimum tax changes is a little bit too complicated to speak to here. But one thing you want to know is that if you're thinking about buying an electric vehicle or doing solar or doing some sort of upgrade to your homes as it relates to clean energy, you have until December 31st of this year to get it done, because then these tax credits go away. These other items we're not going to talk about because they do not impact our client base. Now, what the one big beautiful tax bill did not change is that in 2017, our federal income tax brackets were lowered, and they made the lowering of those tax brackets permanent with this new bill. And they made a minor inflationary adjustment on it. They also made the qualified small business income deduction, that's a 20% deduction, permanent. That was also something new that they added in the 2017 tax bill. So if you're a small business owner and you make less than $400,000, you get up to a 20% deduction from your small business income. This is the biggest one probably that confused people when this tax bill was signed into law, is that there was stuff going around saying Social Security income is no longer taxable for retirees, and that's completely false. The whole calculation on whether your Social Security income is going to be taxable or not has not changed whatsoever. It's just that they're giving retirees some potential additional standard deductions, which may make less of your Social Security income taxable or may not make it taxable whatsoever. I'm going to talk about that here shortly. Also, in 2017, they limited your mortgage interest deduction to $750,000 of total debt. So it's in today's real estate market, it's not unheard of to have a mortgage for more than $750,000. and they made this basically permanent that says you can't deduct mortgage interest of anything above the $750,000 mark. The next item we want to talk about is some positive changes that this bill made but don't really impact your taxes. With the 529s, they actually they made it more liberal, some more expenditures that qualify for expenditures out of a 529. And the other thing that they did is they actually increased, if you send your children to private K through 12, they increased the amount that you can take out of your 529 to pay for those private tuitions from $10,000 a year to $20,000 a year. Also, if you're on a high deductible health plan, they made the HSAs more liberal. They included more plans that are considered high deductible health plans, and they increased the number of expenses that qualify to be able to be withdrawn. Estate taxes. Well, if you happen to be a wealthy person, this is this is a tax you pay if you are wealthy when you die. They raised the exemption amount from $14 million a person to $15 million a person. So if you are a married couple, you would have to be worth more than $30 million before the estate tax comes into play. Another one, which is going to be fun to see where this goes, is they introduced this Trump retirement savings account for young children. So they don't roll this out for another year, but they're planning on pre-funding this. The government's going to pre-fund this retirement savings account for your child if it's born between 2025 and 2028 with $1,000. And then you as a parent or anybody else for that nature can put up to $5,000 a year into this. It's an after-tax contribution, and you can only contribute to it until the child turns 18. But it's essentially just like a 401k or an IRA, gross tax deferred, and it's intended to be for retirement. So you can tap into it after the child turns 18 for things such as first-time home buyers or college education costs, but it will be taxable income to you at that point. You just would avoid the 10% penalty that most people would pay if you tap into it before 59 and a half. So now we're on to the meat and potatoes. This is the stuff that we've tried to put together a schedule that gives you an idea. This is just a made-up kind of scenario to give you an idea of what you may be saving in going forward with this new tax bill. And so most of our clients take the standard deduction, but we thought we'd start with the people who itemize. So when we look at this whole tax law change, it's kind of looks to us as though if you're a single individual or a married couple that make less than $500,000 and you already itemize your deductions, which typically means that you have a pretty high mortgage balance, that you're paying a fair amount in mortgage interest, and you live in a high tax state like California, New York, New Jersey, Minnesota, Oregon, Hawaii, you're going to be impacted the most by this tax law change. And also retirees that make, if you're a single retiree over the age of 65 and you make less than $75,000, you're going to get a much larger standard deduction. If you're a married retiree couple that's over the age of 65 and you make less than $150,000, you're going to get up to an additional $12,000 standard deduction. So those two kind of groups of people are probably going to see the biggest benefit. The rest of us who are kind of, either have little to no mortgage, we don't have, we don't make, we're kind of middle income. We're going to see some benefit, but not big dollars. So in my example on this screen, this is someone who itemizes whether you're single or joint, because what they did is they phased out. There's always phase outs with these new benefits. So if you're high income, if you make over $600,000, whether you're single or joint, most of this tax law changes are not going to affect you whatsoever. So you're going to kind of pay the same taxes. So in 2017, when they changed the tax laws back then, the biggest thing that came out of that is they capped your state and local tax deduction at $10,000. No matter how much money you made, no matter what state you lived in, it was capped at $10,000. Now, itemized deductions, you get the higher of what your itemized deductions are or your standard deduction. And itemized deductions are made up of your charitable contributions, the mortgage interest you paid, and then your state and local tax deduction. So the state and local tax deduction regards, how much do you pay in state taxes when you earn your income? How much do you pay in your real estate taxes? And then if you have to pay personal property taxes on your car and your boats. That's what makes up that state and local deduction of these three items. And these three items, again, have been capped at $10,000 per year. And so what we did here is this first column is under the old, the current law, and then this is the new law, which they said they raised the cap to $40,000 a year as long as your income's not over $600,000. And so in this example, we just again made it up. We plugged in a person's gross income, which then drives which tax bracket you're in, which in this case, this person's in a 22% marginal tax bracket. And so under the old rules, if this person had a huge amount of mortgage interest and they were in a high tax state, so their real estate taxes are high and they pay a lot into the state, they were capped out at $10,000. But in this case, they had $43,000 of deductions, which then you add in the lesser of either $40,000 or what you paid in state and local taxes. And so you can see that if someone does get the full $40,000 cap, it's going to impact their taxes by $6,600. So again, this is just a fictitious example that we put in here. But what drives this is three things. What is your income expectation, which will then tell us what taxable bracket you're going to be in, and then we just need to plug in the numbers in terms of your real estate taxes and your state and local taxes, and we'll understand then how much more of an additional SALT deduction you get. Now, that being said, most of us are going to be continuing to take the standard deduction. And so for this slide, we had to get a little bit more granular. So we have to divide it between a single individual versus a joint because the phase out dollar amounts are different. And then we have to divide it out into whether you're under the age of 65 or over the age of 65. And so what we did with this schedule is, again, it's driven by what you anticipate your income to be, because that will then drive what your marginal tax brackets will be down here. And then we listed out all the new caveats to the One Big Beautiful Bill as it relates to standard deductions. And we also listed out, well, what year do they expire? Because if you looked on the previous screen, that actual SALT deduction expires in 2029, whereas these other ones expire in 2028. So what changes they made to your individual standard deduction is each one of us got an automatic increase in our standard deductions by this new tax law. Single person got $750, married couple got $1,500. Everybody gets that no matter what amount of money they make. Also, starting in 2026, not 2025, if you are charitably minded and you take the standard deduction, up to $1,000 additional dollars will be added to your standard deduction next year if you're single, $2,000 if you're married, provided that you did give at least that amount to charity. Now, the next one is not going to be applicable to everybody, but if you purchase a new car between now and 2028, whereby it's assembled in the U.S. and it's used for personal use, you can now potentially deduct your car loan interest up to $10,000 a year, as long as your income's not more than $100,000 for a single or $200,000 for a married couple. So in this example, we just said, hey, you're a single person, you took a $50,000 loan at 7%, and that equates to a $3,500 additional deduction. Now, you also get this deduction if you itemize your deductions as well, but I didn't put that on the previous slide. Now, in the married column, we assumed you both got new cars and you took out $50,000 loans for at a 7% rate. So that's an additional standard deduction. And then last but not least, this new deduction is only relating to retirees over the age of 65. And again, if you are single over the age of 65 and retired and you make less than $75,000, you get an extra $6,000. And a married couple, if you don't make more than 150, will get an extra 12. So you come down, you do the math, and you say, hey, this is how it's going to impact my taxes based on the tax bracket I'm in. And then for those people who still have children under the age of 17, they increased your child tax credit to $200 per child. So if you have 3 children under the age of 17 and you make less than either 200 or 400,000, you're going to get 200 times however many children as a tax credit, which is a dollar for dollar reduction in your taxes. So hopefully these two scenarios were helpful for you to understand what did change in the tax laws for individuals. And again, I would encourage you to reach out to us if you want us to run a personalized 2025 tax projection for you, because we certainly can do so to kind of hone in on what dollar amounts you may be saving. But then again, if you have any other questions as to what was on this presentation, do not hesitate to reach out. Thanks, and have a great day.